In 1996, the cost of debt hit a record high. Americans spent more than 11% of their after-tax income repaying consumer loans. How can we control our credit card debt? We'll talk with the author of Credit Card and Debt Management. Let's take notes. The average American carries around 9 credit cards with a total running debt of about $4,000. Only 1 in 3 cardholders pays off their balances each month. That means that 64% have debt payments that may cost as much as 28% a year in interest. We'll talk about some simple strategies to help reduce credit card debt. Our guest is Scott Bilker. He is an engineer, not a financier. He is the author, though, of the easy-to-understand guide, Credit Card and Debt Management, which was published by Press One Publishing in Barnegat, New Jersey. Thanks so much for joining us.
You're welcome. Thank you for inviting me onto your show.
As I said, according to Money Magazine, February 1997, the average American has a debt of about $4,000, credit card debt, which is up about 32% from 1992. Why are so many Americans borrowing against their future?
Well, because they can. There's more than 500 million major credit cards in circulation, and with the average cardholder having 9 or more cards. In fact, there was a recent poll in USA Today in which they surveyed people who claim bankruptcy, and the #1 respondent answer for claiming bankruptcy was credit card debt. And the people who did have bankruptcies caused from credit card debt had about $47,000 in debt.
You mentioned credit card or bankruptcy. Bankruptcy has doubled in the last 10 years. 1 million Americans file for bankruptcy every year. You have some solutions to prevent that, because bankruptcy ultimately hurts all of us.
Yes, it does, and it stays on your credit report for about 10 years. But ironically, after bankruptcy, some banks consider you a good risk because you can't claim bankruptcy again for another 7 years. So people still continue to get credit card solicitations.
Speaking of credit card solicitations, there are 2.7 million that go out a year, so that anyone who looks I get several every week. To what extent does that flood of solicitations contribute to our overspending?
Well, it again is another easy way for people to get money, but at the same time, it's an opportunity for those people in debt to get out of debt by paying less money for their loans overall. What I would suggest you do is, when you get a low-rate offer in the mail, and that's one with the big, bold interest rate written right on the envelope, that you write that down and you keep track of the rate, how long it's going to be available to you, what the terms are, how long that rate will be good for, and file that offer away somewhere, so in case one of your banks that you currently have loans with raises the rate, you'll have a new bank to turn to.
Transfer your balance.
Absolutely.
In fact, you currently juggle several dozen, 13 dozen credit cards?
No, 13 dozen.
What was it?
3
dozen. I'm sorry, 13 dozen you couldn't keep track of.
Well, I like to keep my options open. I do have some debt remaining from college loans and other spending, and I want to get the best deals for my debt, and they're all around 6.9%. And I keep rolling them over in 6.9% offers for the last decade, because rates are low right now. And as long as these good deals are available, you should take advantage of them, especially if you're in debt. Because when you get a lower rate, now instead of paying interest to the bank as a fee, you can take that money and pay off your debt with it.
The National Foundation for Consumer Credit recommends that consumers spend no more than 20% of their income on credit obligations. Do you agree with that?
Sure, the less you can spend, the better. If you can pay for everything with cash and you never need to use your credit cards, that's great, but that's not always possible for everyone. Emergencies happen, your car might need to be fixed, something can happen to your house, it might need repairs, and you might have no other option but to use a credit card. But of course, if you can save money and only use cash, that's the best way to go.
I know people who don't use cash at all. They use a credit card to buy groceries. They use a credit card wherever they can and pay off the balance every year. So in essence, they're using someone else's money free of charge for a month.
Yes, that's definitely a good tactic, especially if you have high-rate interest debt, because the money that you're spending, say for your groceries, say you're spending $300 for groceries, instead of taking the cash that you have and paying for the groceries on the spot, take that cash and pay it all back to your creditors at a high rate, and let the new bank that you just charged that purchase to take a zero interest loan for you for that 1 month while you take their money and pay off another debt.
In your book, Credit Card and Debt Management, you have devised a relatively simple method for calculating the time remaining on a loan. Why is it, first of all, so important that you understand how much time is remaining?
Well, because you don't want to get caught up with paying back your debt forever. And also, you can't really formulate a plan to get out of debt unless you know how long you're going to be in it. There are certain basic things you need to know. How much debt you have, how much you're paying towards that debt, and what the average rate is on all your debt, because you want to try to get your payments up, your total amount of debt down, and your interest rate down.
Okay, let's say you have a balance of $5,000 on your credit card. It's 19.8%. If you pay the minimum amount, how long might you be paying off that $5,000, or how much might you ultimately pay?
Believe it or not, it could take you almost 50 years to pay back that debt and cost $24,000 when you're finished. So basically, you're borrowing $5,000 and paying back $24,000. You're paying $96 for a $20 bill is what's going on. And that's very expensive. And that's because your minimum payment is based on how much you owe. And in that situation that you just mentioned, the minimum payment would start at around $102 and slowly drop to $15 over the course of those 50 years. What you could do is just pay a constant $110 towards that $5,000 debt, and even at 19.8, it would be done being paid off in 7 years for only $9,000, and that right there would save you $15,000.
It's interesting, though. You know, you pay a big chunk on your credit card, and the next month they say, oh, take a vacation. Don't pay it this month. I think we should avoid that trap, that enticement to skip a month of a payment.
Certainly on high interest rate credit cards, if you've got credit cards at 19.8 or higher, and some people do, you don't want to pay the minimum. You want to take as much money as you can and pay those off as quickly as possible. But now, say you had a low interest rate card at 5.9% and a high interest rate one at, say, 18%. You want to pay the minimum towards the low rate and take the money you would have paid towards the low rate and apply that towards your payment on the high rate card. That's the way to save. You want to pay the highest rate debts back first.
Lots of people are putting a little bit of money into a savings account while paying only the minimum on their credit card debt. How do you feel about that practice?
If you're in debt, you should not save for emergencies. Let me give you an example. Say you had $3,000 at 18% on a credit card. Your finance charges are $45 a month. Say you also had $3,000 in a savings account at 4%, which would be pretty good actually for a savings account. In that case, you're only getting paid $10. So net it's costing you $35 a month just to have the privilege of a $3,000 savings account where you can save $45 a month. That's $400 a year by just paying it back. Another way to look at that is, say you had no debt and no savings. Would it be advisable to cash advance $3,000 at 18% and put it in a savings account? Because the outcome is identical. You wouldn't want to do that. And besides, in a real emergency, you want to have your credit lines available, because most people will only take MasterCard. Anyway, they're not going to take a personal check if, say, your car breaks down somewhere. They're going to want a credit card.
Many financial advisors, especially when they're dealing with a client who's in trouble, the first thing they tell you to do is cut up your credit card. It sounds like you don't think that's good advice at all.
No, I don't think it's very good, because when you cut up your credit cards, you cut out your options. Say, for instance, you had 3 credit cards, that's all you had, and you had debt on all those cards. And you consolidated that with another credit card, and you cut up the rest and closed all your accounts. And now, for some reason, you missed a payment, and nowadays they'll raise your rate very high if you miss a payment. So now this one bank that you have debt on raises the rates really high, and you have nowhere else to go. You cut up all your other accounts, they may or may not give them back to you, and you're stuck. Now you're going to pay a lot of money for that debt. By just taking that card and putting it in what I call the credit card graveyard, a little file where I just throw cards I don't use and leave them at zero balances. If another bank raises your rate, you call one of your other cards and you say, hey, what kind of deal do you have for me this month? And you'll be surprised to find that when you transfer money in, all of a sudden they have some great rates for 6 months or some other new deal that's very beneficial.
In fact, you claim that you saved $13,000 just by making a phone call.
Yes, let me tell you what happened there. I had an introductory rate of 6.9 going for 6 months. After that ended, they raised it to 22.5. And I called the bank and I spoke to the account rep and I said, I don't like having my rate raised. In fact, it's $40 in charges just for that month in interest. So I said, you got about 5 seconds to do something for me, or I'll just transfer my balance to somewhere else. And they said, you know what? We have this great deal, 8.75%, and you can call back in 6 months to keep it low. I said, thanks, but I don't even want to pay $40 for the finance charges on this month. And they said, okay, we'll refund that to your account also. The savings comes from the fact that at 22.5%, I would have paid $23,000 back, and at the 8.75, it would only cost $10,000, so a $13,000 savings. And you will feel paying $13,000 in the course of years.
Absolutely. You also say, above all, don't be late with your payments. In fact, today, if you're late, they charge you $15 late fee. You say even if you have to borrow the money from someone to pay it on time.
Right. The most important thing to do in your credit history is to pay on time. That's one of the most important, if not the most important factor besides income as far as getting credit. In fact, a friend of mine missed a payment on his mortgage, and the result was that he got a $50 late fee, and when he reapplied for a refinance later on, he was denied, and that cost him thousands of dollars because of the difference in the rate. When he told me about this, I said, you know, you could have used your credit card to pay your mortgage payment. And he said, what do you mean? I said, well, if you cash advanced it and paid your mortgage payment, you were only 15 days late anyway. He got the money together. It would only cost you about $20 for the cash advance, and it would have been paid off in a month anyway. And you would have not had that late on your credit report, and it would have saved money on the fees.
It sounds like a lot of this is common sense. If we took the time, as you have, to really analyze our debt and analyze our income, we'd all be in much better financial shape.
It's just a matter of really understanding what all your options are and taking the time to manage your debt properly, because it's a continuous process. It's like another job. I only spend about 3 hours every 2 weeks doing this, but during that time I look at every single credit card I have, every loan I have outstanding, and I try to find the better deals to transfer the money into to save the most, because I don't want to just throw money away. That's what's going on. You know, I know some people that will drive across town to save a penny on their gasoline, but they don't want to spend 10 minutes to save $100 or more on their credit cards. It's just a matter of taking the time to learn how to save that money, and that's one of the reasons I put the book together, because I feel I have plenty of techniques that can save people a lot of money.
And just with just a couple of seconds remaining, how difficult is it, though, for those who have numerous loans or debts with variable rates? Is it very difficult to figure out how long it's going to take them to pay off a debt?
Not difficult at all. In fact, you don't need anything more than addition, subtraction, multiplication, and division. In my book, I put together a whole bunch of tables that make it very simple to figure out how long you're going to be in debt, how much you owe, and how to figure out which credit card deals are the best.
Okay, on that note, we're out of time. Thanks so much for being with us. Our guest has been Scott Bilker, who is the author of Credit Card and Debt Management, which is published by Press One Publishing in Barnegat, New Jersey. For Take Note, I'm Patty Satalia.